I want to follow up a little bit on Senator Menendez's questions about the analysis that you've made. It's my understanding that if money market funds are forced to float their net asset value, there's a great concern about the fact that the flow of hundreds of billions of dollars of both corporate and municipal financing would be severely disrupted. Have you or your staff undertaken any studies as to how the reforms that you have floated might affect the ability of investors to continue to use money market funds as an effective cash management tool?
Absolutely. As part of our analysis is the impact on state and municipal governments' use of money market funds for cash management. We understand that many of them operate under legal requirements to utilize a stable value product. That's one reason we're proposing alternatives. If you need to use a stable value product, then there's a capital alternative that would allow the money market fund to still price at $1. But we will look at the cost implications for municipalities of both the cash management aspect of money market funds, but also their capacity to buy state and local paper.
But at this point, have you reached any conclusions as to what kind of disruption might be caused in the economy in the development of capital in this context?
Well, we have obviously had conversations with state and local governments. We held a roundtable, excuse me, last year where we had participation from state and local governments talking about the issues, talking about their concerns. Will they need to have additional staff? Will they have to change their programs?
And what conclusions have you come up with from those conversations?
Well, part of our release is to seek specific economic data about what those costs would be, and then be able to compare those costs against the costs of the potential for a run that freezes money market funds, suspends redemptions, and gives them no access whatsoever to their cash management vehicle.
Okay. In April, a committee of the International Organization of Securities Commissions issued a report on the money market funds that included proposals to float the net asset value or imposed other variety of capital buffers. 3 of the 5 SEC commissioners issued I think a rare statement that said that report does not reflect the views and input of a majority of the commission. My question is, who at the SEC did provide the input on this report, and were the 3 dissenting commissioners consulted?
The staff works with IOSCO on an IOSCO committee that was dealing with these issues. The commissioners did disagree with the conclusions. Those disagreements were registered at the highest levels of IOSCO. The paper was published prematurely, quite honestly, before the SEC, through a genuine screw-up in the process at IOSCO, before the commission was able to register that there was not a majority of the commission's support. But I should emphasize this was a consultative staff paper seeking comment on a broad range of potential options.
All right, thank you. Professor James Engel from Georgetown University makes the point that it's extremely important to distinguish between a destabilizing run and an orderly walk. In a run, apparently, as he says, the funds are forced to sell assets at potentially distressed prices, potentially destabilizing money markets. In a walk, the funds can be used in the normal cash flow, in a normal cash flow manner from maturing assets to meet redemptions. Are you focusing on that kind of distinction? Do you agree with that distinction in the first place? And do you think that the reforms that you're talking about properly take into account that kind of distinction?
I think the reforms do take into account that kind of distinction. Our concern is the propensity to run. Our concern is not to keep money market funds in business, to limit people's ability to withdraw and move their money from fund to fund, but our concern is the destabilizing run, such as we saw in 2008. We're very focused on that. We've had a number of our staff look at Professor Engel's report. I think it contains assertions and conjectures and, frankly, qualitative statements, but not the kind of quantitative data and analysis that we would expect to include along with our reform proposals.
So although you may disagree with his analysis, you do agree with the distinction that there is a difference between a run and an orderly walk, as the term has been used.
I think when a fund breaks the buck, it's very hard to have an orderly walk because a fund is likely to suspend redemptions, which just freezes everybody in place, including people who need access to their funds for cash management purposes, payrolls, tuitions, mortgage payments. So my concern is about the potential to break the buck because of the brittleness of the $1 value and that leading to a run.
Thank you.